How target outcome indices work. In uncertain markets, varying levels of risk and volatility may lead anxious investors to make short-term moves that distance them from long-term goals. But what if there was a way to limit risk and target more clearly defined returns at the same time? For years, institutional investors have used sophisticated structured outcome products to provide defined levels of downside protection and upside participation over predetermined time periods. Today, innovations in indexing have democratized access to defined outcomes, providing a simple, transparent, index-based blueprint for target outcome strategies that can be applied to both active and passive vehicles. These strategies have four primary components. The index, often the S&P 500 or an S&P factor index, is the engine that powers the strategy. The buffer acts as downside protection. It can be set at various levels to buffer against loss, from 9%, 10%, 15%, or 30%. The cap is the upside participation component. It will vary in size relative to the buffer and current market conditions. The lower the buffer, the higher the cap. This relationship allows for higher index participation, but a lower level of protection in declining markets. Which is where the fourth component, time, comes into the equation. The timing of the index buffer and cap reset is predetermined before investing and acts as an additional layer of protection when markets are declining. Or conversely, it helps increase upside participation when markets are climbing. Typically, a periodic reset takes place over a one-year period. But just like the other three components, the timing is set to align with the goal of the strategy or the structure of the product it powers. So what does this look like in practice? If a buffer of 15% is applied to the S&P 500 and the S&P 500 drops 20%, a strategy tracking the buffered index would have a net loss of 5%. If the S&P 500 drops 25%, the buffer strategy would only lose 10%. As a result, the predetermined buffer level may offer some peace of mind during down markets, especially for investors who are in or approaching retirement. The trade-off is the cap placed on potential gains. For example, if the current cap on a 15% buffer index is 10% and the S&P 500 climbs 10%, the 15% buffer strategy will too. If the buffered index climbs 20%, the strategy would only gain 10%, as it cannot exceed the index's predetermined cap. However, passive and active strategies built on this framework can employ intra-period or laddered approaches within portfolios to alleviate the burden of market timing. For example, in a laddered approach, 12 buffer protect strategies that reset to index levels on a monthly basis are combined in order to dial up protection during prolonged down markets and increase upside potential when markets are climbing. The key is a simple index framework that can be applied to a range of active and passive solutions. That means market participants, from financial advisors and insurance professionals to institutional and retail investors, can align solutions, including ETFs, mutual funds, and structured products and fixed indexed annuities with predefined goals. Whether it's growth with downside protection, gap risk management, or a complement to guaranteed lifetime income, the time for index-based access to predefined outcomes has arrived. To learn more about our range of target outcome indices, visit us at www.spglobal.com/spdji.